Have you ever wondered how the great investors make their decisions? Enter Peter Lynch, a titan of the investment world, whose name rings synonymous with success and strategy. Born in 1944, Lynch's journey to becoming one of the most successful investors of all time is truly remarkable. He is most renowned for his role as the manager of the Magellan Fund at Fidelity Investments, where he served from 1977 to 1990. Under his leadership, the Magellan Fund burgeoned, becoming one of the most successful mutual funds in the world. His reputation as an investment maven grew exponentially, and he became a beacon of inspiration for many aspiring investors. Lynch's investment prowess isn't just a result of luck or happenstance, it's the product of a well-honed strategy, a deep understanding of the market, and an uncanny knack for finding hidden gems. So how did Peter Lynch manage to achieve an annual average return of 29.2%? Let's delve into his investment strategy. At the heart of Lynch's success lies a simple yet powerful investment philosophy. This philosophy, deeply rooted in common sense, is built around the concept of investing in what you know. It's not about chasing hot stocks or getting swept up in market trends. Rather, it's about recognizing the value in the ordinary, everyday companies that you interact with and understand. Peter Lynch firmly believes in the individual investor's ability to spot potentially successful companies. He argues that you, yes you, have a unique advantage over the big Wall Street firms precisely because of your day-to-day experiences. Think about the brands you trust, the products you can't live without, the services that make your life easier. These are the companies you know and understand. These are the companies you might consider investing in. Lynch's philosophy is grounded in the idea that if you understand a business, its products, its market, its competition, then you are well equipped to make informed investment decisions. You don't need a degree in finance or a job at a hedge fund. What you need is curiosity, a keen eye for detail, and the willingness to do your homework. Importantly, Lynch's approach is not about making quick, easy money. It's about investing for the long haul. It's about finding companies that you believe in, companies that have strong fundamentals and promising futures. And it's about sticking with these companies through the inevitable ups and downs of the market. But how do you apply this philosophy? How do you identify these potentially successful companies? This is where Lynch's buy what you know strategy comes into play. This strategy, which we'll delve into in the next scene, is all about using your knowledge and experiences to identify investment opportunities. This approach, known as buy what you know, forms the backbone of Lynch's investment strategy. It's a strategy that has made Lynch one of the most successful investors in history, and it's a strategy that with time, patience, and a bit of homework, you can use to your advantage. Imagine investing in companies whose products or services you use daily. Fascinating, isn't it? This is the crux of the buy what you know strategy, a principle at the heart of Peter Lynch's investment philosophy. It's all about leveraging your own knowledge and experience to make informed investment decisions. How does it work? Let's break it down. The strategy encourages investors to start their investment journey in familiar territories. It could be your profession, a hobby, or even a product you use regularly. By focusing on industries or companies you know well, you're in a better position to understand their performance, potential, and the challenges they face. Take a moment to think about it. If you're a tech enthusiast, you probably have a better understanding of the latest trends, innovations, and companies leading the charge in the tech world. Or, if you're a healthcare professional, you might be more aware of the companies making strides in medical technology or pharmaceuticals. This familiarity gives you a leg up when it comes to choosing where to invest your money. Now, let's look at how Peter Lynch applied this strategy during his time at the Magellan Fund. Lynch was known for his hands-on approach. He visited companies, spoke to employees, and used their products to gain a deep understanding of the businesses he invested in. He believed that personal experience provided insights that couldn't be found in annual reports or financial statements. For instance, Lynch famously invested in Hanes after his wife raved about their new line of pantyhose. He saw the potential in a product he encountered in his daily life, and that investment paid off handsomely. This is a prime example of the buy what you know strategy in action. However, it's crucial to remember that this strategy isn't about blind investment in familiar brands. It's about using your knowledge as a starting point, then conducting thorough research to make informed investment decisions. But the buy what you know strategy is just one piece of the puzzle. Lynch also had a unique way of categorizing his investments. Peter Lynch did not believe in a one-size-fits-all approach to investing. Indeed, he appreciated the multifaceted nature of the market and identified 6 unique categories for his investments. Let's take a closer look at each of these categories. Firstly, we have the slow growers. These are large, mature companies that offer modest but relatively stable growth. Their appeal lies in their predictability and consistency. They may not be the most exciting stocks, but they often provide steady dividends, which can be a source of regular income for investors. Next are the stalwarts. These are established companies that have a proven track record of reliable growth. They're not as slow as the slow growers, but not as fast as the fast growers. They're the Goldilocks of the investment world, just right. Stalwarts may not provide spectacular returns, but they offer stability and have the potential for moderate growth. Then we have the fast growers. These are smaller, aggressive companies that grow at an above-average pace. They can provide spectacular returns, but they also come with higher risk. Fast growers require careful research and monitoring, as their fortunes can change quickly. The fourth category is cyclicals. These are companies whose earnings fluctuate with the economic cycle. Timing is everything with cyclicals. Buy at the wrong time, and you could see your investment plummet. But buy at the right time, and you could reap significant rewards. Next in line are the turnarounds. These are companies that have been through hard times, but have the potential to recover. They can be risky, but they also offer the chance for significant gains if the company successfully turns its fortunes around. Lastly, we have the asset plays. These are companies that hold assets that may be undervalued by the market. The key with asset plays is to identify these hidden gems before the rest of the market catches on. Lynch's investment categories allowed him to diversify his portfolio and manage risk effectively. By understanding these categories, you too can adopt a more nuanced approach to your investments, just like Peter Lynch. How can we apply Lynch's strategy to our own investments? Now that's the million-dollar question. Well, let's dive right into it. The cornerstone of Lynch's strategy is simplicity itself. Invest in what you know. So the first step in applying this strategy is to look around. What companies do you interact with on a daily basis? Which products can you not live without? These are all potential investment opportunities. Sounds simple, right? But there's a catch. Knowing a company and understanding it are two different things. You might love your smartphone, but do you understand the company that made it? How do they make money? What are their growth prospects? These are the kind of questions you need to answer before making an investment. This is where the importance of research comes in. Lynch was a firm believer in doing your homework. He spent countless hours reading financial statements, attending company meetings, and even visiting stores and factories. Now, you might not have the time or resources to do all that, but at the very least, you should be familiar with the company's business model and financial health. There are plenty of resources online that can help you with this. Once you've found a company that you understand and believe in, the next step is to be patient. Investing is not about making a quick buck, it's about growing your wealth over time. Lynch often held on to his stocks for years, sometimes even decades. So, don't be discouraged if your investment doesn't pay off immediately. Remember, the stock market is unpredictable, prices will go up and down. But as long as you've done your research and believe in the company's long-term prospects, you should stick with it. Don't let short-term fluctuations scare you off. And that brings us to the end of our exploration of Lynch's investment strategy. It's a simple yet powerful approach that can yield great results if applied correctly. As Peter Lynch once said, the real key to making money in stocks is not to get scared out of them. So, keep your cool, do your homework, and trust in the companies you understand. Peter Lynch's investment strategy is not just about picking stocks. It's about much more. It's about understanding the companies behind those stocks, the industries they operate in, and how they make their money. It's about investing in what you know and understand. This strategy encourages us to become more engaged and knowledgeable investors. It asks us to do our own research, to delve deep into the inner workings of a company, and to truly understand the market in which it operates. But perhaps the most important aspect of Lynch's strategy is patience. The stock market is not a get-rich-quick scheme. It's a long game, one that requires perseverance and a steady hand. So remember, when you're considering your next investment, ask yourself, do I truly understand this company? Am I willing to be patient and let my investment grow? In the end, investing, as per Lynch, is as much about understanding oneself as it is about understanding the market.